the stock market, the most important organ is the stomach. It's not the brain. There's always, on the way to work, the amount of bad news you can hear is almost infinite now. So the question is, can you take that?
Hello everyone, welcome back to Value Hunt. Today we're diving deep into the world of investing, especially focusing on the concept of 100 baggers. Ever wondered how to turn $1 into 100? Stick around. First, let's clarify what a 100 bagger is. This term comes from the legendary investor Peter Lynch. Simply put, a 100 bagger is a stock that increases 100 times in value. So if you invest $100,000 and it turns into a 100 bagger, you end up with a cool $1 million. This doesn't happen overnight, but when it does, it can be a game changer for your portfolio. Now, the risk is limited to what you invest. If you put in $100,000, that's the most you can lose, assuming you're not using leverage. But the upside, that's limitless. Imagine having 5 stocks. Even if 4 go to 0 and 1 becomes a 100 bagger, you're still in a great position. Lastly, a piece of wisdom. In golf, a slight adjustment in grip and stance can improve your game. Similarly, in investing, buying with the intent to hold long term can significantly boost your returns. Think of it this way: in the stock market, standing still can actually make you run fast, provided you've chosen the right business and management team. The concept of a 100 baggers strategy was significantly influenced by investor Chuck Akre, who himself was inspired by a book titled 100 to 1 in the Stock Market by Thomas Phelps. Akre came across this book in 1972 after it was reviewed in Barron's. While Peter Lynch was popular for talking about 10 baggers, Phelps took it a step further by discussing investments that could return 100 times their original value. Reading Phelps' book helped Akre focus on the critical importance of compounding capital. Phelps not only provided examples of such high return investments, but also outlined the characteristics that could lead to such exponential growth. This book and its principles became a cornerstone in Akre's own investment philosophy, which he later shared in his 2011 talk titled An Investor's Odyssey: The Search for Outstanding Investments.
In 1972, I came across a book that was reviewed in Barron's called 100 to 1 in the Stock Market. And it was written by a Boston investment manager. His name was Thomas Phelps. And what was interesting to me was that it really made me come around and focus on the idea of compound return.
Chuck Akre has been in the securities business since 1968 and has a unique approach to investing that he calls the three-legged stool. So what does Akre look for in an investment? First, he's all about businesses that have shown they can compound their value at high rates over time. Second, he wants to see skilled managers who treat shareholders like their partners in the business. And third, he zeroes in on companies that can reinvest their free cash flow at above average returns. But as Akre has matured in his investment journey, he's boiled it down to one essential thing: reinvestment. It's a driving force behind compounding and ultimately achieving those 100 bagger returns. In fact, he prefers companies that don't pay dividends because it means they have more capital to reinvest, which leads to a higher compound growth over time. Akre isn't just talking theory here, he's got the track record to prove it. Take Berkshire Hathaway, for example. He bought shares back in 1977 for just $120 each. Today, those shares have grown an astonishing 4.6 thousand times in value. And then there's American Tower, another stellar performer in his portfolio. He bought in at 80 cents a share, and those shares are now worth $167 each. He's also a man who values deep, meaningful discussions about businesses and stocks. He doesn't get sidetracked by market trends or economic indicators that are out of his control. And he's been greatly influenced by Thomas Phelps and his book 100 to 1 in the stock market, which perfectly aligns with his own philosophy of long-term investment and the magic of compounding. Akre is also not afraid to bet big on his big ideas. Often half of his portfolio is concentrated in his top 5 to 7 picks. So, if you're looking to master the 100 bagger strategy, taking some cues from Charles Akre might be a great place to start. He focuses on the fundamentals, ignores the noise, and lets the power of compounding do the heavy lifting. Let's talk about the first rule for finding 100 bagger stocks. You have to actively look for them. It sounds obvious, but it's crucial. Thomas Phelps, the man who literally wrote the book on 100 baggers, starts off with a simple parable about wishes. If you wish for one donkey, you're only going to get one. If you wish for 10, you'll never get more than 10. The point is, aim high from the start. Phelps also shares an analogy from elephant hunting. He says, when looking for the biggest game, don't be tempted to shoot at anything small. In other words, don't waste your time and mental energy on stocks that might give you a decent yield or a 30 to 50% return. You've got limited time and resources for stock research. So focus on the big game, the potential 100 baggers. Moving on to the next crucial point for finding 100 bagger stocks, growth. But not just any growth. We're talking about good growth. You see, it's not enough for a company to just increase its sales or earnings. What you want is value-added growth. That means growth in sales and earnings per share, not just inflating numbers by issuing more shares or cutting prices. Now, you might be wondering, should you focus on sales growth or earnings growth? The answer is ideally both. But there are examples like Comcast and Amazon that had a high sales growth without showing much in earnings initially. The key is to look at earnings power, which is a long-term assessment of a company's ability to earn above-average returns at above-average growth rates. But how do you know if a dip in earnings is just a temporary setback or a sign of something more serious? The answer is simple. Know the business you've invested in. Let me give you an example. There's a company called General Finance. They lease containers and their stock took a hit because of a slowdown in oil and gas sales. But did that affect their long-term earnings power? No. They still had their assets, their diverse customer base, and their high returns on capital. So the takeaway here is spend less time listening to market forecasters and more time understanding the businesses you invest in. That's the only way you're going to spot a potential 100 bagger. Next, let's dive into the price you're willing to pay for a stock. You don't want to overpay, but you also don't want to scrape the bottom of the barrel. For instance, if you buy a stock at 50 times its earnings, you're setting yourself up for a tough climb to make it a 100 bagger. You need those earnings to skyrocket 100-fold while keeping the high PE ratio. That's a tall order. But on the flip side, if you're only looking at stocks with low PE ratios, you're probably not going to find your next big winner. So, how do you find the sweet spot? One tool to consider is the PEG ratio, which divides the PE ratio by the annual EPS growth rate. If a company's earnings are growing at 20%, a PE ratio of 20 would be fair, giving you a PEG ratio of 1. Anything much above 1 could be overpriced. Take Interactive Brokers as an example. They are a fast-growing business that traded at about 25 times earnings a few years back, but their earnings growth rate was impressive, making the higher multiple justifiable. Charlie Munger, the vice president of Berkshire Hathaway, once said that over the long term, a stock is likely to deliver a return that's close to the business return on capital. So if a business is generating high returns on capital, even a higher multiple can be justified. The bottom line, lower multiples are preferred, but don't let a higher multiple deter you from investing in a great business with strong growth prospects. Always balance the price you pay with the quality and growth rate of the business. Also consider the concept of twin engines of 100-bagger. This is when an investment has both incredible growth prospects and starts at a low PE multiple. It's like having two powerful engines propelling the investment skyward. For instance, MTY Foods began at just 3 times earnings and saw its earnings rise more than 12 times over a decade. What really turbocharged this investment was the increase in its price to earnings ratio from 3.5 to 27. The result was a 100-bagger. It's important to note that such a perfect storm is rare, but it serves as a compelling example. When both growth and a low starting multiple are working in favor of an investment, the potential returns can be astronomical. Let's talk about the importance of economic moats for a company. An economic moat is essentially a competitive advantage that allows a company to earn high returns on capital over a long period. This is crucial for any investment aiming to be a 100-bagger. Imagine a company with a book value of $10 per share that earns a 15% return on that capital. If it doesn't pay dividends, its book value will double in 5 years and quadruple in 10 years. In 33 years, it could be a 100-bagger, but if it pays out a third of its earnings as dividends, it would take 15 years just to quadruple its capital. So dividends can be a costly luxury if you're aiming for maximum growth. That said, dividends aren't always bad. They've been important for the overall return of many successful investments, but ideally, you'd want a company that can reinvest all its earnings at high rates. Debt can also play a role. A company earning 15% on its capital could potentially boost that to 20% by taking on some debt. But remember, this also increases the risk. So, when looking for a potential 100-bagger, focus on companies with high returns on capital and the ability to sustain those returns over the long term. In other words, look for companies with an economic moat. Next, let's discuss the size of the companies you should be considering for your 100-bagger quest. The idea is simple. Start small to grow big. Think of it like planting acorns to eventually have oak trees. Larger companies like Apple are already so big that the chances of them becoming 100-baggers are practically zero. For Apple to give you a 100-fold return from its current valuation, it would have to be worth more than 4 times the entire US economy. That's not likely to happen. But don't think you have to go hunting for tiny, obscure companies either. The study shows that many 100-baggers started off as fairly sizable companies with median sales around 170 million. So a good rule of thumb, look for companies with market caps under 1 billion. While it's not a strict requirement, focusing on smaller companies will likely make your search for 100-baggers more fruitful. Another key factor to consider in your search for 100-baggers is the leadership behind the company. It is often beneficial to invest in companies led by owner-operators, those visionaries who not only run the business but also have a significant stake in it. Think of iconic leaders like Sam Walton of Walmart, Steve Jobs of Apple, or Jeff Bezos of Amazon. These are individuals who had skin in the game, and their interests were closely aligned with those of the shareholders. Investing alongside such owner-operators can give you added confidence, especially during the market's inevitable rough patches. Remember, no one creates a stock for the sole purpose of making you money. You're able to invest in it because someone else decided to sell it. So when you invest with owner-operators, you're essentially becoming a partner in the business. What's good for them, it's good for you. However, it's worth noting that while having an owner-operator at the helm is preferred, it's not a strict requirement. There are companies that have delivered exceptional returns without a well-known CEO. So, while it's a good rule of thumb to seek out owner-operators, don't make it a deal breaker. One of the most crucial elements in finding 100 baggers is time. Even the fastest growing companies took about 5 years to reach that 100-fold return, and most will take 20 to 25 years. The challenge here is not just finding the right stock, but also having the patience to let it grow. That's where the coffee can approach comes in. The idea is simple but effective. Create a separate portfolio, and whatever stocks you put in there, commit to holding them for at least 10 years. No selling, no second guessing, just let them grow. Why 10 years? Because experience shows that this long-term approach often yields at least one big winner and generally performs better than portfolios that have actively being managed. So if you're serious about finding a 100 bagger, consider the coffee can approach as a strategy to defeat your own impatience and tendency to do something. Let your investments mature naturally and give them the time they need to potentially deliver those outsized returns. In the quest for 100 baggers, one of the biggest obstacles is the noise. Financial media, market pundits, and daily stock fluctuations can distract you from your long-term goal. The truth is, stock prices can swing wildly for reasons that have little to do with the actual health of a business. For instance, Monster Beverage saw months where its stock plummeted by 20% and then rebounded just as quickly. The business itself didn't change that dramatically in a month. It's just market noise. Another distraction is the broader stock market trends. While it's tempting to look at indices like the S&P 500 to gauge market health, remember that grey stocks can and do emerge even in stagnant or declining markets. Between 1966 and 1982, a period often cited as dead money for stocks, there were still 187 opportunities to invest in stocks that would have returned 100 times your investment. So the key takeaway is this: develop a strong filter to tune out the noise. Focus on the fundamentals of the business you're investing in rather than getting caught up in the market hysteria or broader economic indicators. Great investment opportunities are always out there. You just need the right focus to find and hold on to them. One of the most challenging questions in investing is, when should I sell? The answer might surprise you. If you've picked the right stock, the best time to sell is almost never. This philosophy has been the cornerstone of some of the greatest fortunes in history. Take the Astor family or Ronald Reagan, a janitor who left an $80 million estate. They bought quality stocks and held on to them for decades, reaping the benefits of compounding. Now, there are exceptions. You should consider selling if you realize you've made a mistake in your initial analysis, or if the stock no longer meets your investment criteria. But these decisions should never be based solely on stock price or market noise. Some investors use stop losses to automatically sell when a stock drops a certain percentage, but this strategy can kick you out of a stock right before it rebounds and grows exponentially. Remember, investing is a long-term game. The real money is made by sitting tight on a well-chosen investment. So, if you're aiming for those 100 baggers, your best strategy is to buy right and sit tight. In conclusion, there's no secret recipe for finding stocks that will give you a 100-fold return. No magic formula or simple screen will do the trick. What you can do is stick to the core principles we've discussed. Keep them in your back pocket as you navigate the investing landscape. Remember, the journey to finding 100 baggers is a marathon, not a sprint. And while it's crucial to do your homework and make informed investment decisions, let's not forget the role of luck. Take Apple, for example. No one could have predicted in 2002 that they'd revolutionize entire industries with the iPod, iPhone, and iPad. And sometimes, even the most solid investment can be undone by unforeseen events or innovations that disrupt the market. So, while it's important to be diligent, it's equally important to acknowledge that luck plays a part in investment success. The key is to be prepared so that when luck does come your way, you're in the best position to capitalize on it. In the end, luck is a factor that neither can be controlled nor predicted, but it's a part of the game we all play. So, the next time you're evaluating a stock, think about its 100-bagger potential. Remember, the key is to find a great business and just sit tight. If you found this video helpful, don't forget to hit the like button, share it to your friends, and subscribe for more content.